You ever look at a stock price on the screen and just think, is that really what this thing is worth? It's probably one of the biggest questions in all of finance, right? And it's what separates a lucky guess from a really smart investment. So, today we are going to crack the code that Wall Street analysts use to figure that out. Let's dive in.
All right, so we see prices flashing on our screens all day long. They're up, they're down. It's just the constant noise of the market. But hiding underneath all that chaos is a much deeper, kind of mysterious number, a company's true value. And the gap between that price and that value, well, that's where the magic happens.
So let's just get right to it. That price you see for a share of, say, Apple or Tesla, is that its actual fundamental worth? Well, the simple answer is not always, not even close sometimes. And figuring out why, well, that's the key to everything we're about to talk about.
Okay, so to get from the noise of the daily price to a real understanding of value, analysts use a special framework. You can think of it as their secret weapon. And no, it's not magic, it's just a really powerful equation that helps cut through all the complexity. And here it is. This is the code we are going to decipher together. Now, I know at first glance it might just look like a bunch of alphabet soup, but trust me, stick with me here. By the end of this, you are going to know exactly what this means and how it shapes pretty much every major investment decision out there.
Let's start with the easiest piece of the puzzle, P. P is just the market price. It's the number you see on your phone, on the news ticker. It's what it costs to buy one share right now. Simple, right? Straightforward. No debate on this one.
Okay, now for V. This is the intrinsic value. And this is a much bigger idea. See, it's not the price, it's what the company is fundamentally worth. If you could somehow add up all its assets, its future earnings, its brand, the whole shebang, you'd get its intrinsic value. Think of it as the real, honest-to-goodness worth of the business, totally separate from the market's daily mood swings. And that brings us to our final piece, VE, or estimated value. Now, this distinction is absolutely critical. So while V is that true, perfect, but let's be honest, ultimately unknowable value, VE is an analyst's attempt to calculate it. It's their educated guess, their thesis, built on all their unique research and financial models. And that is why no two analysts will ever have the exact same VE for a company.
So let's go back to our equation and just split it right down the middle, because the whole game of valuation really it boils down to these two parts. On one side, you've got V minus P. That's all about finding a mistake the market is making today. On the other side, you've got VE minus V, which is all about you having a better, smarter vision of the future. Let's break those down. First up, let's talk about finding those market mistakes. This is that classic, old-school value investing idea. The whole goal here is to find a company where the price today is just, well, it's just plain wrong compared to what the company is actually worth right now.
Think of it like this. That V minus P part of the equation, it's basically bargain hunting. It's like finding a real designer watch at a pawn shop for half its actual price. You're not trying to predict the future. You're just pointing out that this watch, right here, today, is already worth way more than its price tag. The value is there. The market just isn't seeing it for some reason. Okay, now let's flip over to the other side of that equation. This part isn't about today at all. It's about tomorrow. It's about your unique insight. It's you betting that your vision for the company's future is way more accurate than what everybody else thinks. You see, this is a totally different kind of bet. You're not buying a bargain that exists today. You're buying pure potential. This is VE minus V. It's like finding an unknown artist and believing their painting's going to be a masterpiece in 5 years. Your estimated value is way higher than its value today because you see a future that, frankly, everyone else is missing.
So here's the crucial point. Successful investing isn't usually about just one of these things. It's about understanding how both pieces of the puzzle work together to create your investment thesis. You have to know, are you playing the bargain hunter game, the futurist game, or maybe a little bit of both?
And that brings us to the main takeaway. Every single time you buy a stock, you really should ask yourself these two simple questions. Number one, am I betting that the market's price is wrong today? That's your V minus P. And number two, am I betting that I'm smarter about this company's tomorrow? That's your VE minus V. Your edge as an investor has to come from one of those two places, and knowing which game you're playing is absolutely critical. So I'll leave you with this to think about. The next time you look at an investment, which side of that equation are you really leaning on? Are you a hunter looking for today's bargains that are valuable right now? Or are you a prophet predicting a future that only you can see? The answer to that question really defines what kind of investor you are.